One of the biggest mistakes new traders make is jumping straight into live markets with an untested idea. They see a setup that worked twice on a demo account or looks good on a chart, and boom, they go live. And when it doesn't perform the way they expected, they think the market's rigged, or worse, they think they're just unlucky. But the truth is, luck has nothing to do with it. What's missing is evidence. Real, data-driven validation that your strategy has a statistical edge. And that's exactly what backtesting gives you, the bridge between idea and execution, between theory and confidence. Backtesting is the process of taking your strategy and running it against historical data to see how it would have performed in real market conditions. No real money, no emotions, just raw performance under the microscope. Here's the key: the goal of backtesting isn't to find the perfect strategy. It's to find a reliable one. As the legendary trader Larry Williams once said, a good system doesn't need to be perfect, it needs to be consistent. And that's what backtesting reveals: consistency under pressure. When you backtest properly, you start to see how your strategy behaves during different market conditions, trending phases, consolidations, high volatility, low liquidity. You start identifying where it shines and where it struggles. And that knowledge is power. It allows you to anticipate, adapt, and avoid emotional decision-making in live trading. Let's walk through the process in simple terms. First, you define your strategy clearly. That means knowing exactly when you enter, when you exit, how much you risk, and under what conditions you stand aside. No vague "I'll buy when it looks bullish." It has to be rule-based and quantifiable. Then, you collect reliable historical data for your market and timeframe, accurate, consistent data. If you're trading euro to US dollar, for instance, you might want 10 years of daily data, or several months of tick data if you're a short-term trader. Once you've got your data, you implement the strategy on a backtesting platform. That could be MetaTrader, TradingView, OmniBroker, or Python, whatever fits your workflow. You code or simulate your rules. And then you run the test. And that's where the fun begins. The backtest gives you raw performance metrics: win rate, average profit, drawdown, expectancy, profit factor, and overall return. These numbers tell you how your system performs statistically, not just emotionally. Now let's bring this to life with a case study. John, a trader I've mentioned before, decided to build a simple moving average crossover strategy on euro to US dollar. He used a 50-period moving average as his short-term signal and a 200-period moving average as his long-term trend filter. His rule was simple: when the 50 crossed above the 200, he'd go long. When it crossed below, he'd go short. And every trade risked just 1% of his capital. He ran his backtest from 2010 to 2020, a full decade of data, including some very different market environments: the Eurozone crisis, the 2014 dollar surge, Brexit, and even the early pandemic volatility. The results were surprisingly solid. His win rate came in around 45%. Not amazing at first glance, but here's where traders often misunderstand statistics. Win rate alone means nothing. What matters is expectancy, the average profit per trade relative to the average loss. John's average winning trade was about 150 euros, and his average losing trade was 100 euros. Over hundreds of trades, that math adds up. His maximum drawdown stayed under 15%, and his total compounded return was roughly 120% over 10 years. Not bad for a mechanical system that required zero emotion and very little discretion. But John didn't stop there. He noticed the system struggled in choppy, sideways markets. So he optimized, testing different combinations of moving averages. Eventually, he found that a 40-period and a 180-period combination worked even better, improving overall profitability and smoothing out drawdowns. And here's where most traders fail: they stop optimizing too soon or over-optimize to fit past data. Overfitting, or curve fitting, is like designing a system that would have perfectly predicted yesterday, but fails tomorrow. To avoid that, John validated his optimized system on out-of-sample data the system had never seen before. He ran it from 2021 to 2022, and the results were consistent. Not identical, but consistent, same logic, same edge. That's what robustness looks like. Only then did John move it into live trading, following the exact same parameters. Over the next year, he stuck to his plan, didn't override signals, and ended up with steady, reliable profits, not flashy, but real. This is the essence of backtesting, discipline before action, as Paul Tudor Jones once said, losers average losers. And I'd add, losers also trade untested strategies. Because if you don't know how your system performs historically, you're basically flying blind. Backtesting gives you that visibility, but here's something that's often overlooked: backtesting also builds psychological confidence. When you know your system has survived bad markets in the past, you're far less likely to panic when the next drawdown hits. You trust the math. You trust the edge. You become consistent, because you've proven your consistency before. And if you want to take your testing to the next level, don't just backtest on one time frame or market. Test across instruments, forex, indices, commodities. Test under stress, during news events, flash crashes, and quiet sessions. The more data you collect, the clearer the truth becomes: good systems survive, weak ones don't. The ultimate goal isn't to build a backtest that looks perfect. It's to build one that feels real. Something that captures how your strategy truly behaves, warts and all. So, as you continue to refine your trading plan, make backtesting a habit, not a one-time project. Integrate it into your weekly or monthly review process. Because when you treat backtesting as your laboratory, you stop gambling and start engineering performance. And that's when trading gets exciting, because now, every trade isn't just a bet. It's a validated hypothesis with a measurable edge. Now, let me leave you with a question for today's episode: if you could backtest one element of your trading right now, would it be your entry rules, your risk management, or your exit timing? Think about it, and share your answer in the comments. I'd love to hear where you think the biggest performance gains can come from. Because ultimately, trading success isn't about predicting the future. It's about proving your process. And backtesting is the proof that transforms intuition into precision. Until next time, trade smart, stay systematic, and remember, the edge isn't found in emotion, it's found in data.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.